All right, guys, so we got a lot to get to today. We got stocks like Apple, basically around all-time highs. We got Nvidia rocking right around all-time highs. A lot of stocks making all-time highs, which basically means it's ballooning out our portfolios. And of course, when that happens, the question always comes up, what do I do? Do I trim? Do I take some profits? I mean, how do you handle a situation where a stock is becoming outsized in your portfolio? It may start off at 10% or 20%, but now it's ballooned up to 50%, 60%, maybe even more. And same exact thing when you're adding to stocks that are beaten down. Sometimes you just end up adding so much, it makes up a huge percentage of your portfolio. So let's talk about exactly how to handle that situation, exactly what to do. And we'll do all that right after you like the video, if you like getting the truth without the hype, guys. And that's what you're going to get today. All right, so this is actually a video that I released in my group some time ago. So it's a little bit older video here, but it speaks exactly to this, exactly what to do, and it was in response to a question in the group about that there. So I figured I would share that with you guys here on YouTube today, but make sure you check out the pinned comment down there for a membership there if you want insights like this all the time, or to be able to ask me this exact question in regards to a specific stock, and we can actually talk through it and all that good stuff. So much involved there in the group, guys. I'm not going to bother with it here. Just check out the pinned comment, see everything you get, and see if a membership's right for you. But with that said, let's jump into the video here. All right, guys, so I saw some good discussion in the group there about ballooning positions, what to do whenever you have a stock that you want to add to, but that stock makes up a huge chunk of your portfolio there, 35%, 45%, 50%, whatever the number is there. How do you add whenever you're getting a nice pricing, great pricing in some cases, and you have your portfolio balloon like that? So I'm going to kind of give you the long-term investor's perspective here, and kind of why the idea of keeping percentages and everything else within your portfolio, it's in the courses too, but I'll cover it here specifically in regards to this particular scenario. It's kind of a fallacy to do that, because that's what funds do, because they have to. They can't let positions balloon out too big. Therefore, they have to trim positions to keep, they can't own any more than 10% of stock X or 10% of stock Y, or, no position can be making up more than 15% of the fund, or whatever the case is. Those are kind of the rules of the fund, and that's where that thought process came from. But if you notice the greats, the Warren Buffetts, the guys like that, they don't take profits just to take profits. They don't worry about what percentage of my portfolio is made up of this particular stock or that particular stock, because you're just punishing winners. And let me explain this to you guys a little bit more, just so that way it makes a little more sense. Whenever I look at all of my portfolios across the board, I don't know the exact percentage, but I know it is more than 50% of it is made up of Apple. But yet, every time Apple goes on a significant dip, I add the stock. Last time was at like 117, 116, something like that dollars, up big on that particular buy. But it didn't make any sense for me to buy if I was looking at percentages. The way I actually choose to analyze how much my portfolio, my percentages are, and everything else like that, I don't do it that way at all, because as your portfolio matures, if you let your winners win, I let Apple win for me to the tune of 54,000% gain. That doesn't happen if I'm trimming along the way, or I'm trying to keep Apple at 15% of my portfolio or whatever. It can never grow into this beast that it is in my portfolio and make tons and tons and tons and tons of money for me without doing anything, by the way. All I had to do was just hold and add on the dips. That's all I had to do. That doesn't happen if you're constantly trying to balance your portfolio out and do things like that. So for me, I look at dollar amount in. It doesn't matter. I actually have more money in my portfolio, dollars I spent in Tesla, than I do Apple. But yet Apple is, 10 times the size of my Tesla position, because it took such little money to grow into such a large position like that. Same thing with, Google, or take whatever stock you want there in my portfolio. I count the dollar amount into it, not what percentage it makes up of my portfolio, because if I did that, I would have a much smaller portfolio, because I would just be punishing those winners that have run. Yeah, I've grown out a huge Palantir position because I really believe in Palantir long term. But guess what? It hasn't, it's gone on a very nice run. Don't get me wrong. From my average, we've at least doubled up, maybe a little bit more. I hadn't looked at their price recently, so I don't know. But nonetheless, I put a lot of money into it. But again, it does not near the size of some of my other positions. However, it's outgrown some other positions. So again, I would have started trimming that position depending upon how I wanted to balance my portfolio, or whatever the case is. So when you're looking at how I view it, is I view my money that I'm looking at is, when I'm initially building out, how much money do I want to put into? How much money do I want to risk on that particular stock, right? And then as I'm adding bonus shares, it is strictly about putting my money where I think it's the best deal at the time to put money into. Remember, I also have all my money loops going and everything else. I've done everything in the courses and have been doing that. Those took decades to build out. It's not like that happened in a year, 2 years. But if you don't start today, and the habits don't start today, you won't be able, 10 years from now, you'll be kicking yourself in the butt because you're still at square one instead of having all that stuff built out. So I know there's more money coming in, so I need to basically make a decision. Where's the best place to put my money? Now, sometimes that is just, I'm going to hold cash because I just don't like any deals out there right now. That happens from time to time. Maybe I buy a little bit of, recently here, it's been buying a little bit of PayPal here and there because, hey, I need to expend some of this cash. I don't need to pull up this much and do some things of that nature. But in general, it comes down to, I don't care if Apple makes up 50% or 60% or whatever the case is. If Wall Street gets dumb and beats it down to, the low 100s again, I'm going to buy more Apple. It's just going to happen because that is the best use of my capital at the time, assuming nothing fundamentally changes with Apple. That makes the most sense in regards to where to put my money, regardless of what size it makes up in my portfolio. And that's the way I choose to view things, is the money into it. And as your portfolio matures and as you get your money loops going, and again, everybody wants everything now, today, in 6 months, in a year. Hey, build this stuff out over a decade. And you got to think of this thing, unless you're 85 years old, you have decades to go in this game, whether you like it or not. I know everybody, if you're young, you're like, hey, I'm 22 now, and I want to retire by the time I'm 35. That's an awesome goal. In the meantime, build all this other stuff out and understand that your needs, your income, your life is going to change significantly in that time frame. And you'll be very, very glad you did all this other work to where maybe you get to where you can retire at 35. Maybe you can't yet, but either way, you want to be putting your capital to work in the best place possible at that particular point in time. Now, I'm not saying overexpose yourself or because Tesla's on a dip, go all on Tesla, which actually, if you look at Tesla's valuation right now, it's really not on much of a dip, if anything, even at this depressed price because the EPS has gone down so much. But nonetheless, you just need to look at what is the best place to put my capital and not worry about that as much. Now, I understand if this is your first year worth of investing, you kind of want to quote unquote diversify it a little bit more. Okay, I understand that to a degree. But for me, it is about putting money in the best place possible at the best pricing possible when I can. That's kind of what I'm trying to illustrate with the $250 challenge. It's just, hey, where do I think the best place to put my money is that's going to make me the most money over the course of the long run? And I'm not necessarily worried about percentages or anything else like that, because in the future, if these stocks do what I think they're going to do, right? If Tesla does what you think it's going to do, Palantir does what you think it's going to do. If all these stocks do what you think they're going to do, your percentages are going to be all screwed up anyways. And the only thing you'll be asking yourself or telling yourself is, and it's a good spot to be in, is, man, I wish I would have bought more. That's it. Which one's going to 10x? Which one's only going to double up? Which one's going to never go anywhere? Nobody really knows the answer to that. That's part of investing. It's part of the reason why I don't just go all in on one stock, as we've seen with all those people that went all in on Tesla. And heck, they missed out on, double up and triple ups in their portfolios in the time they decided to go all in whenever it was at its all-time high. Not a good idea. But you also don't know which one of these stocks is going to run, whether you have 5, 10, or whatever the case is. But I'm not going to punish my winners. And more importantly, just simply I'm getting a little bit fat. Now, I'm not saying go overboard with it, but don't let that be the only determining factor in if you balloon out of position or not. And definitely when I think about it and I look at it, I don't care what the percentage is. One, I'm not looking across my portfolios and trying to figure out what the percentages are. I'm not doing it. Don't care. I don't even look at my portfolios, if you guys want me to be perfectly honest. I don't log in and look. I literally have my screen set up to show me whenever I log in, shows me the S&P, and then I click trade. I pick which account I want to trade from. I click the stock and I go, and I don't do anything else. That's it. I get an email telling me what the order is and I'm done. That's all that I do. I don't look at all. I haven't looked in a very, very long time because I don't want emotions of my account being way up, way down, whatever the case is. I don't want those emotions. I don't invite them, so I don't look. I know that's hard for some of you guys to imagine who log into your account multiple times a day, but remember, I'm old. I remember having to drive to the broker and hand him a check. And then he had, I think it was, I don't remember, it was several days to actually execute on whatever I told him to do. And I filled out the paperwork and all that sort of stuff. And then I would receive something in the mail about 2 to 3 weeks later telling me what I owned and what price I owned it at. And then I had to go buy a Wall Street Journal and hope that the stocks that I bought are in the back there and I can actually see what the price is that day. That's it. I wasn't on the internet. The internet probably existed at the time, but I definitely didn't know how to look up stock quotes or how to use the internet or anything else like that. Just didn't. So that to me was how I got it. I got my quarterly statement from my brokerage and it would tell me what my stocks were doing. That's how often I checked, and that's what I'm used to. And that's why I don't check all the time. I don't, you guys show me. I'll show you. I use the Webull app because I think it's a great app. I don't have any money there. I'm not supporting it or anything else like that. But I think it's a great app to get stock quotes, but I have no idea what my portfolios are doing that day. There's no money in there. I basically look at it. It has my watch list in there so that way I can see the prices for the day. So I can set my plan for the day that we talk about there in the courses. And that's it. That's all that I do. I don't log in and do anything else outside of that. I haven't. My accountant's put together a nice little deal that tells me my overall returns for everything that I own, real estate, businesses, everything else like that. I never look. You know, it's one of those things. It's there, but it's something I never look at because I don't care. I'm focused on the future. I'm focused on what's my next investment. What is my next business plan? What is my next, thing that I'm going to engage in there? What's the next property I'm going to buy? What is the next syndication I'm going to look at? What's the next business opportunity? That's where my mind is. That's where my focus is. So when I come back to this and I look at it, it's just strictly dollar amount in. And really, like I said, when I'm doing this $250 portfolio challenge, I'm not even looking at that. I'm just worried about what's the best deal at the time and the best stock that I think is going to give me the best return. I kind of have my, I'll reveal them as they happen. I'm not going to tell you the whole list, but I kind of have my group of stocks there that I think this is how I would start it if I had to start all over again. Obviously, that's a very different perspective than where I'm at now, where, owning, 30 plus stocks makes sense. We're in the situation I'm in right now with all my other portfolios, but in a portfolio like that, that doesn't make sense. So I've got to narrow that down to the stocks that I believe are going to do exactly what I said. Hey, I'm 46. I'm looking to obviously build out as much wealth as I can. I'm not completely risk averse, but I see no point in buying Coca-Cola and stocks like that. If I'm 46 and I'm starting at zero, guess what? You ain't going to get there at $250 a week to be able to retire in any sort of reasonable time frame or to have a nice nest egg there in your portfolio buying stocks like Coca-Cola. So I have to be aggressive, but I'm not going to be stupid aggressive either and just buy all penny stocks or all spec plays or whatever the case is like that. I think you can have a very nice, well-rounded portfolio with moderate risk, what I consider moderate risk, doing it the way that I'm doing it there. So that's exactly what I'm going to show you guys with that. So anyways, hopefully that kind of gives you my perspective on ballooning out positions, making sure you're not penalizing a great stock that just happens to have run, but would still be a great stock in the future. Think about if you bought Meta at the lows. Maybe that's the example I should have led with. If you bought Meta in the 80s and all of a sudden it doubled up or tripled up, man, that's great, but you still would have been at 240 bucks or so. Still a great stock to add, and you'd have a double up almost from there, at this stage. With Meta, if you would have continued to buy instead of going, ooh, it's kind of ballooned up to a big portion of my portfolio, I should probably lay off of it. No, a great stock at a great price on a significant discount is exactly that, and it's the right stock to buy at that time, in my opinion, of course. So, and remember, if you want to see content exactly like that, you want to see all my buy and sell alerts in real time, see my complete watch list with price targets, take 5 courses for free, use our stock analyzer tool for free, be a part of the best 6, 7, and 8-figure Discord out there, get your free coaching. Guys, there's so much. Check out the pinned comment, see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.